Hello everyone. We are continuing with the same practice questions, and I'm sharing the next question. And again, 3 minutes time to solve this question. Your time starts now. In this question, examiner is asking you, ignoring the residential nil rate band, how much normal nil rate band is available against Wong's estate. Remember the concept in IST? Nil rate bands can also be transferred in between spouses. So here is a person named as Wong's estate, and examiner has asked you to calculate the total normal nil rate band which is available against Wong's estate. In effect, we need to solve Wong's estate normal nil rate band. And we know one thing, that first of all, person's own nil rate band would be available. And for every person for the fiscal year 23-24, nil rate band amount is 325,000. And Wong's wife's nil rate band can also be available. We don't know the amount, but for surely if any unused nil rate band available, which is from the which is available from the death of the Wong's wife, that can be added at time of Wong's nil rate band calculation. Okay, let's start reading the scenario. W died on 4th Jan 24. This is fiscal year 23-24, when his wife Wink died on 3rd August 19. That's in the fiscal year 1920. Her entire estate, wife's entire estate of 200,000 was left to Wong. If any estate transferred in between spouses, then nil rate bands are available. They are not used because any estate transferred in between spouses is exempt for IST purposes. However, wife's Wing had made a gift of 100,000 to her daughter on 2nd May 2019, and after making this gift, wife died on 3rd August 19. And the gift amount of 100,000 is after deducting the available exemptions. The nil rate band for the tax year in which the wife died, 1920, nil rate band is 325,000. So basically, an X amount is to be added to the husband's nil rate band because it's wife's available nil rate band which will be transferred to husband, right? But for getting this X amount, for calculating that X amount, we have to perform few calculations with respect to wing. First of all, if you start checking the lifetime transfers, and there is a lifetime transfer that Wing had made a PET, a gift to daughter, on 2nd May 2019, and the value of PET is 100,000, and PETs are exempt at time of death. So basically, although the question is not asked for Wing, question is asked for Wong's estate normal rate band availability. But for finding this, we have to calculate, we have to check the Wing's death and state availability nil rate band. Thereafter, Wing's death day is um, 3rd August 19. 3rd August 19, that's a fiscal year 1920. At time of Wing's death, we will check, we will look back if any asset is transferred within 7 years or not. So at that time of Wing, we have checked that the PET which made on 2nd May 19, this PET of 100,000 is basically taxable. This asset is becoming taxable at time of death. Yes, we are discussing question 21. And any asset which become taxable at time of death, fiscal years 1920 nil rate band is 325,000, and this is covered by the nil rate band of 1920. From this 325,000, 100,000 has already been used because this asset was taxable and covered by the nil rate band. So the remaining nil rate band amount is 325,000. Whereas it's given in mention, at time of death, firstly we check the lifetime transfers which become taxable at time of death, and then at last stage we talk about estate, and estate transferred to husband and exempt, and nil rate band is unused. For which nil rate band we are talking about? This 325,000, in fact 225,000. from 325,000, 100,000 is being covered when this asset became taxable at time of death, and remaining 225,000 nil rate band is available, right? And if we convert this amount to percentage from 225,000 divided by 325,000 into 100, so that's giving us an unused percentage. Keep remember, if you remember from the conceptual discussion, we don't want the amount of the unused nil rate band. In effect, we want the percentage of unused nil rate band, and that percentage is multiplied with the nil rate band of the remaining spouse death. So this person is died in 4th Jan 24 in the fiscal year 23-24. For this year, nil rate band amount is 325,000, which is multiplied with the unused nil rate band percentage. This is giving us 225,000, and adding both the values, we will get 550,000 is the total nil rate band which is available at time of Wong's death. So basically, this area asked in question about Wong's state available nil rate band. But for solving this area, for getting this amount, we must check the Wings thing, the wife's death, wife's lifetime transfer, wife's death thing, any asset which become taxable at time of death, covering the nil rate band of death year, calculating the available nil rate band of 225,000, then checking the unused nil rate band percentage, and then using that percentage with the nil rate band in which the remaining spouse dies, right? Okay, moving forward towards the next question. Here we go. That's an easy question. Examiner is asking you to calculate the value of PET which is made on this date to his daughter. Any asset which transferred in life from person to person transfer is termed as potentially exempt transfer. On 22nd May 22, that's fiscal year 22-23, W made a gift of 4,400 to his son. In this year, he made a potentially exempt transfer, and on 7th September 23 in fiscal year 23-24, he made a gift of 7,200 to his daughter, another PET, because for IST purposes, person to person transfer of asset in life is termed as potentially exempt transfer. The person has made two transfers in 2 different years. One asset is transferred in this fiscal year, and the second asset is transferred in the fiscal year 23-24. Examiner is asking to calculate the value of PET for the asset which is made on this date, and it means examiner is asking you to calculate the value of PET which is made in the fiscal year 23-24. We must remember the net PET value concept and how we can calculate net PET value by deducting the annual exemptions, right? This PET which transferred in this fiscal year, the value of PET is 7,200. When it comes to taking the annual exemption, so current year annual exemption is deducted at first priority. It's the first transfer in this year, so we are deducting the annual exemption of 23-24. Whereas previous year annual exemption can also be deducted if it's available. So we have to check whether it's available or not. Can you please tell whether it's available or not? It would be available if there is no asset transferred in previous year, and if the question is silent. It can be available. Annual exemption of previous year can be available in two situations. If question is silent, if nothing is mentioned in question, then we can also take the previous year annual exemption. And if any asset is transferred in previous year, then it has already been used in previous year, so it's not available for current year. So there's a scenario. He has already made a transfer of, of an asset in previous year. So previous year 3,000 exemption has already been deducted in the previous year transfer. So if it is not available, net PET value will be 4,200. So D is the correct option. Hope everyone attempted it correctly. Moving forward, For IST purposes, whenever we talk about the lifetime transfer, so there could be two lifetime transfers. One of them is called potentially exempt transfers, and second one is called chargeable lifetime transfer. Potentially exempt transfer is when a person transfer an asset to person, and CLT means when a person transfer an asset to trust. PET is always exempt at time of transfer. PET is exempt at transfer time, or we can rephrase this as potentially exempt transfer is always exempt in life, whereas CLT may become taxable in life when CLT value is more than the nil rate band of transfer year. And the as it is become taxable in life, once this condition is met, then the tax can be calculated. If trust perform calculations, trust would be using tax rate at 20%. When this tax amount is calculated by a person, so that is calculated at 25%. So here this concept is known as grossing up of CLT. Let me guide you again. Let me repeat. There are two lifetime transfer. One of them is PET, another one is CLT. Potentially exempt transfer is always exempt in life, whereas CLT may become taxable when the CLT value is greater than the nil rate band of the transfer year. And if this is the case, then if trust perform calculation, the tax rate will be 20% for IST purposes in life. And once this calculation is calculated by the person, then the tax rate will be 25%. And now keeping all these things in mind, let's start reading the scenario. On 12th June 23, fiscal year 23-24, Arnold made a gift of 440,000 to trust. That's a CLT. This year nil rate band is 325,000, where the CLT amount is more than the nil rate band, means this condition is now met. This 440,000 is deducting after available exemptions. Okay, means we are not required to deduct 3,000 and 3,000. Arnold will pay the IST arising from the gift. This statement is linking from here. Person would be paying the tax, means grossing up concept is applicable. He has not made any previous lifetime gifts. Okay, fine. So let's talk about the CLT value. CLT value is 440,000. And if we compare it with the nil rate band of the transferred year, and this asset is transferred in the fiscal year 23-24, this year nil rate band is 325,000 on the excess amount of 115,000. As it is mentioned that person would be paying IST, means person's calculations will be performed at 25%, and resultingly 28750 is the amount of tax. So that was a requirement. Examiner has asked us what is Arnold's lifetime IST in respect of the gift made to trust. So this is the lifetime IST of 28750, which a person has to pay when this asset is transferred to trust. Participants who are asking about this, are you clear on this now? They asked me to give some guidance on this. Are you clear now? Perfect. Okay, now the next question is pertaining to the same thing. If I ask you when this asset on which this tax is calculated, can you please identify the date when this IST is to be paid? That's the transfer date. That's the transfer date. I'm asking you to check when this tax is to be paid. You can open up your notes. You can check when this tax is paid in lifetime. There are two conditions basically. If I recall, if asset is transferred in between April to September, that's a different timeline. And if asset is transferred from October till March, then lifetime IST paid date is changed then. Can you please check by keeping this transfer date in mind. That's 12th June 23. If an asset is transferred in life and any tax is calculated, and if the asset is transferred in between April to September, then the tax payment date is 30th April after fiscal year. And if this is the case, then the IEST will be paid 6 months from month end of transfer. So can you please check when this asset is transferred? This asset is transferred in June 23. This asset is transferred in June 23. June 23 is falling here. June 23 means if this as tax is to be paid, that tax will be paid on 30th April 24. June 23 is in between April to September. Then 30th April after fiscal year. Fiscal year 23-24 starts on 6 April 23 and ends on 5th April 24. If you follow 30th April after fiscal year, 30th April after fiscal year, so the relevant date will be 30th April 24, means this amount of tax will be paid on 30th April 24. And if you move forward and discuss the same question on the next slide, an asset is transferred on 20th November 2023. Alex made a gift to trust, that's a CLT, and this is resulted in a lifetime IST of 46,000. As for previous question, we calculated the lifetime IST of 28750. In this, that is directly given, the lifetime inheritance tax is already calculated, which is 46,000. Examiner is asking you the due date for IST liability payment of 46,000. And if you check the transfer date is 20th November 23. Basically, it's falling in this situation, October to March. It's in between October to March. And for this, we have decided that the tax will be paid 6 months from month end of death, a month end of transfer. So first of all, take the month end of this month. If an asset is transferred on 20th November 23, the month end date will be 30th November 23. And if we start counting 6 months, December, Jan, Feb, March, April, May. So the relevant date will be 31st May 24. So C is the correct option for this question. Hope now you recall the relevant area. Is everyone clear on this, please? Perfect. Perfect. It's not about death IST. It's about lifetime IST, which is calculated on CLT. By the way, death taxes, which may be calculated on PET, which may be calculated on CLT, which may be calculated on estate. Any tax which is paid at time of death, that is to be paid 6 months from month end of death. Here, 6 months from the month end of transfer, but any IST which is paid at time of death, that is always 6 months from month end of death. Whether it's on PET, whether it's on CLT, whether it's on estate, any tax, any IST which is calculated at death time, that is to be paid on 6 months from month end of death. Okay, moving forward. That's very tricky question. By the way, before please be with me and try to understand a concept. If I say that's my customer, it means that that person is already purchasing from me. If I use a term, that's my potential customer, means that customer is not my customer, but can be my customer. That's a potential customer. Means potential means a possible customer, right? So the term used potential means it's not actual, but can be done in future. So potential means the possible, right? In this question, you are required to calculate the what is potential IST saving, not the actual, but that can be saved, the potential IST saving. Now you can start reading and selecting your appropriate answer. If we talk about the availability of residential nil rate band, what are the preconditions for having this residential nil rate band? There must be a residential property. Residential property means the main residence. It is transferred to direct descendants. Direct descendant could be children or grandchildren, and this is transferred to grandchildren at that time. So if all of the conditions are met, then a residential nil rate band can be claimed. And residential nil rate band amount is for the fiscal year 23-24 is 175,000. Plus, we know one thing that a spouse unused nil rate band can also be transferred. Okay, let's read the scenario now. V has an estate valued at 700,000, but currently she does not have own a main residence. Means this RNRB would not be available as there is no main residence. Although under the terms of her will, V's estate is left to children, means all of the estate will be transferred to direct descendant at time of death. V's husband died on 26 May 19 and all of his estate was left to V. Means any nil rate bands which are available that can be transferred to spouses, because the entire estate was transferred in between spouses, means the nil rate bands are unavailable and can be transferred. What is the potential IST saving? What is the possible IST saving? What IST can be saved if we use some of her assets to purchase a main residence of 340,000 prior mean before to her death. If the person purchased a residential property before the death, it means this amount of residential property will be added to state and RNRB can be claimed. Plus, according to this statement, V's husband died and all the estate is transferred to V, means her husband's nil band can also be taken. So if this is the possibility, if a main residence is purchased, then RNRB can be claimed. How much RNRB can be claimed then? V's own residential nil rate band can be used as 175,000. V's husband RNRB can also be claimed. It means total residential nil rate band would be available to the extent of 350,000 if there is an estate, if the person purchased an estate before death. Furthermore, estate value is given, residential property value is given in question as 340,000. There's a possible value of residential property. This can be covered by the residential nil rate bands, which are available to the extent of 350,000. But can we use 350,000 or we should use restricted residential nil rate band? Yes, we have to restrict the amount of residential nil rate band because property value is not more than the nil rate band. So instead of taking 350,000, we must take 340,000 as nil rate band. So the property value will be nil. It means due to this availability of residential nil rate band, IST would be saved. If from the state value 340,000 is an additional residential nil rate band which can be claimed, so IST would be saved at 40%. So 340,000 into 40,000 into 40%, that's giving us a tax saving of 136,000. So B is the correct answer. Are you getting all these points? Let me repeat. First step to check the conditions for the availability of residential nil rate band. We have checked. And current situation is person is not having any residential property, but in the requirement it is asked that if the person purchase a residential property of 340,000, so what could be the IST saved? Then we check the total RNRB available at time of death. Then we compared the residential property value and we restricted the residential nil rate band and the nil rate band which can be claimed. To this extent, IST could be saved. Can you please give me your input? Are you clear on this? So there's a potential IST saving. This IST can be saved. All of you, please. Your active responses are highly appreciated. Moving forward, here we have scenario for next 5 questions. This scenario relates to question 26 to question 30. And you should assume that today's date is 20th March 24. Min and Mon, a married couple, are respectively aged 76 and 70. Min age is 76 and Mon age is 70. They are married couple. Here we have date of Min and here we have date of Mon. Two persons information is given in question. And let's read the scenario. Min has a chargeable estate for IST purposes valued at 850,000. Min's chargeable estate is directly given as 850,000. He owns two properties respectively valued at 336,000 and 413,000. The first property has an outstanding mortgage payment of 160,000 and second property has an outstanding mortgage interest only of 84,000. By the way, is it mentioned about any property is residential property or not? You need to consider this point because that may lead towards the availability of residential nil rate band. Min owes 18,400 in respect of the personal loan from the bank, and he also verbally promised to pay legal fee of 4,200 incurred by his nephew. Min expect that the cost of funeral to be 5,400 and this cost will be covered by the 6,000 which he has invested in ISA account. By the way, all of these things have already been used in the calculation of chargeable estate. Because normally, what's the formula to calculate the chargeable estate? From the total assets, we deduct the allowable expenses and liabilities, then we get the chargeable estate. Chargeable estate is already given in question, means all of the paragraphs are used in the calculation of chargeable estate. Under the terms of his will, Min had left all of the estate to his children. Children are direct descendant. The residential nil-rate band is not available. Reason being, nowhere it is mentioned that any property is residential property. So that's the reason residential nil-rate band is not available. And here we have the scenario, and here we have the data about the lifetime transfers of Min. On 22nd August 2014, Min had made a gift of 110,000 to his daughter. And on 12th October 23, he made a gift of 200,000 to his son. Both the lifetime transfers are potential exempt transfers. Both these figures are after deducting the available exemptions, means 3,000 and 3,000 and any available exemption, marriage exemption, small amount exemption, all these have already been deducted from here. Then residential, the nil rate band for the tax year 14-15 is 325,000. August 14 is 14-15 and October 23 is 23-24. Here we also get the nil rate band amount for the fiscal year 14-15. What about Mon? On 25th March 24, Mon is planning to make a gift of 1,000.1 ordinary share in ACE Limited, which is an unquoted investment company, to her son. Mon currently owns 5,500 shares out of ACE Limited issued share capital of 10,000, means the current shareholding is 55% before transfer. And the ACE Limited shares are worth at 16 for a holding of 10% and 21 for a holding of 45% and 36 pound for a holding of 55%. So we have read the scenario. Here we have the first question. The requirement of the question is, what is the net value of two properties and related mortgages which will have been included in the calculation of Min's chargeable estate of 850,000? Means what amount of properties have been added to this estate, and properties data is given in this paragraph. So you are requested to please calculate the amount of the properties. Usad, your answer is incorrect.
This meeting is being recorded.
Here we go. If we talk about property one valued at 336,000 and property two value is given as 413,000. And we know mortgages are allowable deductions from the property's value. First property mortgage is 160,000 and property two mortgage is 84,000. If we deduct this, we will get 176 and 329,000. The sum of these two would be 505,000. So correct option is option C. So this amount have already been used in the calculation of chargeable estate. The properties amount of 505,000 have been added in the calculation of the estate. Moving towards the next question. Your time starts now. In question 2 of the scenario, requirement is what is the total amount of deductions ignoring mortgage debts, because mortgage debts have already been deducted from the property's value. Apart from the mortgage debts, what are the total amount of deductions which will have been permitted in the calculation of means chargeable estate of 850,000? Means what are the amounts which have already been deducted in the calculation of this given chargeable estate? Here we have means on owes 18,400 personal bank loan. That's an allowable deduction. And he has also verbally promised to pay legal fees. This verbal commitment is disallowed. And means expect to cost of funeral is 5,400. And it's not necessary to know where from these funeral costs will be covered. That's irrelevant for us. So basically, there are two deductions which have been permitted in the calculation of chargeable estate. First amount is 18,400. Second amount is 5,400. Total amount is 23,800. 23,800. Correct option is option D. Moving forward. Requirement of this question is what amount of IST will be payable in respect of means chargeable estate, which is valued at 850,000 if he were to die on 25th March 24. If you remember, IST on estate is calculated on a last priority at time of death. At that time, first we check any lifetime transfer within 7 years, they will become taxable at that time. They will cover the nil rate band first. And at last priority at time of death, the estate is taxed. And here we have the lifetime transfers on 22nd August 14, he made a PAT, and on 12th October 23, he made a PAT. Both these amounts are after available deductions. So I'm guiding you in a bit detailed working. So I'm basically breaking it into two. First of all, we will talk about means lifetime transfers. First asset is being transferred on 22nd August 2014. That is PET valued at 110,000. As it's a lifetime transfer, it will remain exempt at time of death, at time of transfer. Second asset is transferred on 12th October 23, and the asset value is 200,000. 12th October is 10th month 23. This PET of 200,000 PET remain exempt at transfer time. But when we talk about the death day of the person as mentioned in question is 20th March 2024. That's fiscal year 23-24. This year nil rate band is 325,000. But standing at death time, first of all, we should look back to the lifetime transfer, whether any lifetime transfer is within previous 7 years or not. So if we check about 22nd August 14th PET, this PET is exempt. Why? Because the transfer date and the death date, the time gap in between these two dates is more than 7 years time period. So this asset will remain exempt at time of death. But if we talk about second lifetime transfer, which is transferred on 12th October 23, this PET of 200,000 will become taxable. Reason being the time in between the transfer of asset and the debt is less than 7 years. So this asset is becoming taxable at time of death. So that year nil rate band of 325,000 will cover this taxable asset. And if this asset is covered by the nil rate band, how much nil rate band is still available? That's available to the extent of 125,000. And as I guided you that at time of death, last priority should be given to estate. So estate's tax is calculated on a last priority. Estate is given in question as 850,000. From the estate, remaining nil rate band can be deducted, and remaining nil rate band is 125,000 and differential is 725,000. Death state tax is always calculated at 40%. So 290,000 is the value of IST. So 290,000 B is the correct answer. So for solving a question, you at times you need to prepare a detailed working, and based on that working, you can find your correct answer. Moving forward, here we go. The requirement of this question, what value will be transferred by Mon? It's about second person in respect of her gift of 1,000 shares in ACE Limited to her son. If you remember the concept of diminution in wealth, you can easily attempt this question. Take your time. Requirement of the question is what will be the transferred what will be the trans value what value will be transferred by Mon in respect of her gift of 1,000 shares to her son. Keep remember, it's not talking about the net PET value, it's only about the value of transfer. If the requirement is to calculate the net PET value, then we can deduct annual exemptions. But if the only requirement is to calculate the value of the transfer, then do not deduct the annual exemptions. On 25th March 24, M is planning to make a gift of shares, which is an unquoted company. Before gift, he has holding of 55%. If from 5,500 he transferred 1,000 shares, then remaining shares will be 4,500, and that will represent 45% shareholding of the company. This concept is basically diminution in wealth. Diminution in wealth. Any asset value for IST purposes is checked according to this concept: diminution in wealth or reduction in estate. If you calculate the value before gift, he had 5,500 shares of the company representing 55% shareholding, and according to 55% shareholding, each share worth will be 36. That will be 198,000. And if we check the value after gift, as he has gifted 1,000 shares, so the remaining shares will be 4,500, and according to 45% shareholding, each share worth will be of 21, and that's 94,500. The difference of these two will be value of PT, value of the transferred shares. The difference of these two is giving us a value of 103,500. So C is the correct answer for this question. But if the examiner asks you to calculate the net PAT value, then we can deduct the annual exemption. Annual exemption of which year in which the asset is transferred, 23-24. Then annual exemption of current year, then annual exemption of previous year. Both the exemptions can be deducted, and thereafter we will say that the net PAT value is calculated. We must look at the requirement and to answer accordingly. If only the value of PAT is asked, then do not deduct the annual exemption and straightforward mention the amount which is calculated as 103,500. Last question of the scenario. Requirement of the question is what might be benefit? Why might it be beneficial for IST purposes for Mon to skip a generation so that lifetime gifts are made to her grandchildren rather than to her children? So might why might it be beneficial? It's not necessary always, but it can be done by skipping the generation. So what could be the objective by skipping the generation? Asmita, your answer is correct. No, Abu Bakr, that's incorrect. No, Ikra. What's the main objective of skipping the generation? For example, there is a grandfather who is of ill health, and grandfather's son is also of ill health. So instead of transferring an asset to son, directly transfer the asset to grandchildren, because if both the persons, the grandfather and father, died within few years or few months time period, then IST will be calculated at two different stages. But if the assets are directly transferred from grandfather to grandchildren, then IST will only be calculated at for one stage only when the grandfather will be died. So basically, the agenda for skipping the generation to avoid the double charge to IST. C is the correct answer. So what's the possible agenda, possible objective for skipping the generation? To avoid double charge to IST. Okay. Another question. It's a general question, not linked to any scenario. Please don't take it easy. Although it's easy, but that there are some tricks involved, so you need to answer appropriately. How the how will the motor car be treated when calculating Joe's capital allowances? J is self-employed. During the year ended 5th April 24, he purchased a new motor car with CO2 emission of 62 grams per kilometer. It's more than 50 grams. So the percentage will be 6%, but need to decide the column. The motor car is used by an employee. It's used by employee. Employee use is considered as if any car is used by employee, this use is considered as business use, because if it is mentioned that Joe is using that car, so then it will be treated as privately used asset. But employee use of car is treated as business use, and 30% of the mileage is for private journeys. And if any car is given to employee, then business private use distinction is irrelevant for us. So basically, it's a 6%. It must be kept in a special rate pool. A student might the student who answers incorrectly, they thought that this car is used by Joe is self-employed person. Joe is self-employed person and owner. If any asset is used by owner, then it must be kept as a separate asset in a privately used asset column. But it is clearly mentioned that it is used by employee, so employee use is considered as business use. Based on this discussion, our correct answer is B. It will be kept in a special rate pool. For example, if it is mentioned that this car is used by a self-employed person, then we will say that it will be kept separately and it's a privately used asset. Then D would be our correct answer. But you need to check the scenario very carefully. This car is not used by the owner. This car is used by employee, and employee use is considered as business use. Whether it's for car, whether it's for any other asset, still if employee is using any asset, that asset use will be considered as business use. Moving forward towards the next question. During the year ended 31st March 24, Circle Limited incurred leasing cost of 2700 in respect of a motor car. So it's basically a car rental of 7200. And CO2 emission is 84 grams. 84 grams is more than 50 gram per kilometer. How much leasing cost will be deductible in calculating the Circles Limited trading profit for the year ended 31st March 24? That's very easy, by the way. Let me guide you concept. Leasing cost of car. 100% allowable expense or 85% allowable expense. Leasing cost will be 100% allowed if CO2 is less than 50, 85% allowed expense if CO2 emission is more than 50. So this is a scenario in our question. As the car CO2 emission is more than 50 gram per kilometer, so 85% of the lease rental cost will be allowed expense. 2700 into 85%, so 2295 is the leasing cost which can be deducted. So C is the correct answer. I hope you remember this concept. If the car CO2 emission is given in question which is less than 50 grams, then we will say that complete amount of 2700 is an allowable expense. But if the CO2 emission of car is more than 50 grams per kilometer, then 85% of the rental will be an allowed expense. Moving forward, take your time. Requirement is what expense claim can S make in respect of her business travel? Keep remember, when in employment income, when the car is provided by employer, then car benefit is calculated. And if the employee is using his or her own car for business purposes, then mileage allowance calculations will be performed. I repeat, in employment income, if car is provided by employer, then car benefit is calculated. But if the car is being used by employee his or her own self, means employee is using own car for business purposes, then mileage allowance calculations will be performed. And mileage allowance calculations are different for employment income purposes, and mileage allowance calculations are different for NIC purposes. For mileage allowance for employment income purposes is calculated based on the first 10,000 miles and excess miles. In this question, S uses her own car. S Simon is an employee who is using own car means mileage allowance calculations will be performed for business travel, and during the tax year she drove 13,600 total miles in respect of the performance of duties without any reimbursement from the employer. If employer is not reimbursed any amount, then the calculated amount can be deducted from the employment income. What expense can claim in respect of business travel means mileage allowance is asked for employment income purposes. So let's calculate 10,000 and the excess miles are 3,600. To this extent, it is calculated at 45 pence per mile. On the excess miles, that is calculated only 25 pence per mile. That's 4,500 and over here 900. Total amount is 5,400. That's correct option is D. But in the same question, if the mileage allowance is asked for the NIC purposes, that what amount can be taken to NIC, in that case, the whole amount of 13,600 will directly be calculated at 45 pence per mile. In effect, an amount of 6120 is calculated. But this is not asked in the question. I just attempted this to recall that a mileage allowance for NSE purposes is calculated differently, wherein we don't use 25 pence per mile, right? Requirement of this question is to calculate J's taxable benefit in respect of the company car for the tax year 23-24. When a car is given by employer, then the car benefit is calculated. J was provided with a new petrol-powered company car on 6 Feb 24. From this date, 6 Feb 24, fiscal year end date is 5th April 24. In effect, the month of Feb and March, 2 months. For 2 months, car is used in the fiscal year. So this benefit is month portion and only 2 months benefit will be calculated. The motor car has a list price of 18,900 and official CO2 emission of 117 grams per kilometer. So formula is the cost of car multiplying it with the CO2 emission percentage and multiplied with the number of months. Cost of car is given in question as 18,900. We don't know the percentage, but from the car provide date till the fiscal year end date, there are only 2 months involved. So it will be month apportioned. And as it is mentioned that car CO2 emission is 117 grams for the first 55 grams, the relevant CO2 emission is 16%. And from 117 minus 55 divided by 5, so that's calculated as 12%. In total, 28%. By the way, it's a petrol car. If it's a diesel car and if it's a diesel car and not meeting the RDE2, then we shall be adding extra 4%. But over here, 18,900 into 28% into 2 upon 12. So that's giving us a value of 882. That's correct answer. Car benefit is option A, 882. This question is from VAT, and on in VAT, if we talk about fuel, on fuel, both the taxes output VAT and input VAT are calculated. And for calculating output VAT, we have two methods. One of them is output VAT can be calculated by based on any one. Can you please tell? One of them is charge to employee, and the other one is scale charge. And input VAT is calculated on actual fuel cost. If you remember this, in VAT, on fuel, output and input VAT both are calculated. Output VAT calculation, any one of these two is used, and input VAT is always calculated on the actual fuel cost. So what's asked in question? How much input VAT can be claimed in respect of fuel? Only this area is asked in question about the input VAT. Rest of the information is to be ignored for answering this question. B is self-employed and has a motor car which is 60% used for business purposes. During the quarter ended 31st March 24, he spent 720 on fuel for business and private mileage. So there's the actual fuel cost. 720 is the actual fuel cost. The relevant quarterly scale charge is 306. Both the figures are inclusive of VAT. If the inclusive amounts are given, so these are the gross amounts. Quarterly scale charge amount is 306, but that is to be ignored because only the input VAT is asked in the question. So if 720 is an inclusive amount, so it is to be divided by its percentage. For VAT purposes, gross amount is net amount is always 100%, VAT rate is 20%, so gross amount will be 120%. So amount given divided by its percentage, multiply by required amount percentage, and we required the VAT, and VAT percentage is 20%. So 120 is the relevant amount, B is the correct answer. So this is how you have to check that from where area, from which area, from which concept the question is tested. Okay, moving forward. This question is also asked from VAT, and the concept named as text point is tested. In text point, we need to decide that for which quarter the VAT would be pertaining. In text point, there are three different timelines. First of all, the basic text point, then invoice issue date, and third is payment or invoice before basic text point. Basic text point is basically termed as the delivery date, the date on which you performed your obligation. You transferred, you like delivered the goods or rendered the services. So that is the basic text point, the delivery date, right? J is a decorator. On 20th July 23, he started contract to decorate an office building and completing the contract on 23rd August 23. So this is the contract completion date. So there's a delivery date 23rd August 23. An invoice was issued for full and final amount on the of contract on 3rd September. So there's an invoice issue date 3rd September 23, and this was paid by the client on 10th November 23. Okay. And here is also a relation of 14 days in between the basic text point and the delivery date. So basic text points and the invoice issue date. If normally the basic text point is that date when you completed the contract, when you delivered the goods or rendered the services, and this date is 23rd August 23. By the way, third point is irrelevant because payment made by the customer in effect after, it's not before, it's after the completion, right? The customer paid us on 10th November 23, so it's after the delivery. So this third point is irrelevant for the question. Then check if the invoice is issued within 14 days after delivery. If the invoice is issued within the 14 days after delivery, then this date will become your text point. So check when you issued invoice. Yes, it's within 14 days because from 3rd August 23, if you start counting, 3rd September 23 will be within 14 days time period. So this invoice issue date will become your text point. Let's say it's 10th September 23. Then the time gap in between these two dates is more than 14 days. Then you will say that basic text point is your text point. But as in this scenario, invoice is issued within the 14 days after the delivery, then this invoice issue date will become your text point. So C is the correct answer. This question is asked from VAT and a concept named as reverse charge is examined. Reverse charge mechanism. Reverse charge says that when the goods are imported to UK, when the goods are imported to UK, then show, I, I'm highlighting this word, then only show the input VAT, output VAT, and claim the same input VAT. It's just not the actual, just show on your return. Reverse charge says that when any person importing anything to UK, then charge a tax on his or her own self as output VAT and claim the same input VAT. Means the net impact will be nil, and actual output VAT will be calculated and paid when goods are sold in UK. Actual output VAT will be calculated and paid when the goods are sold in UK. Ming prepared VAT returns for the quarter ended 31st March, 30th June, 30th September, and 31st December on 10th May 23. By the way, if quarter is ending on 31st March, so Jan, Feb, March, April, May, and June, July, August, and September, October, November, and December. These are the months which are involved. In the quarter two, that's quarter one, that's quarter two, that's quarter three, that's quarter four. 10th May 23 is in quarter two. She purchased standard rated goods costing 5,000 from an overseas supplier. Overseas supplier means goods are imported to UK. These goods were sold for 8,000 on 2nd August 23. That's in quarter three. These figures are exclusive, means these are the net amounts. Treatment is what interest will be made on Ming's VAT return for these goods. So B is the correct answer. Why? Because when the goods are imported in UK, the value was 5,000. On 5,000, if we calculate tax at 20%, so the relevant value will be 1,000, and also claim the 1,000, net impact will be nil. And when these goods are sold in UK for 8,000, then on 8,000 amount, a 20% tax 1,600 will be calculated as output VAT. So now take the things. Input and output VAT, of 1,000 for the quarter ended 30th June, that's quarter two, and that's quarter three. And output VAT, only the output VAT of 1,600 for the quarter ended 30th September, that's in quarter three. So this is the relevant answer. Part B is correct answer. I hope the students who made mistake are now clear on this. Okay, here we go. You're welcome, Usad. Here we go. In which circumstances a VAT registered business will be required to issue a VAT invoice? Two things to consider. The business is VAT registered, and when the VAT registered business is required to issue a VAT invoice. Okay. Examiner is asking you, okay. Okay, noted, Musa. VAT registered business be required to issue a VAT invoice. Two things to consider. Business is a VAT registered, and when the registered business is required to issue a VAT invoice, right? When standard rated supply is made to any customer, this statement is incorrect. No. When a standard rated supply to a VAT registered person, then the VAT invoice is required to be issued. So C is the correct answer. When a standard rated supply must be standard rated and it is to be made to a VAT registered customer. If both the conditions are met, then a business is required to issue a VAT invoice. Why statement B is incorrect? When any type of supply, due to this fact, this statement is correct? No. When a standard rated supply. When any type of supply is registered to a VAT customer, no. Not any type of supply. Over here, both these things were incorrect in part B, whereas in part D, this statement is incorrect, although the second half is correct. But the statement in which all of the things are correctly mentioned, that's option C. So C is the correct answer for this question. Okay, next question. That's very easy. Which items of information is not required on a simplified VAT invoice? No, we are supplying, although we are making a simplified VAT invoice, our own registration number must be there. Is there? This must be there. Yes, that's important. Examiner is asking you not required. So C is not required. So that's the answer. Supplier name, our own name will be on the invoice because we are the supplier. We are selling goods. The rate of VAT applied, yes, this is to be also mentioned on invoice. As we are issuing a simplified invoice whose values is less than £250, this thing is not required to be mentioned on invoice. The customer's name and address, because the value of the invoice is not that much higher. So that's the reason we are issuing a simplified VAT invoice, and C is the correct answer. This information is not required to be shown on the VAT invoice. Last question. What examiner has asked in this question? How will an overpayment of VAT of 5,400 be reclaimed from HMRC? Let's say in one quarter you have overpaid to HMRC. So what's the procedure for reclaiming that? So A is the procedure for reclaiming that by entering it on the current VAT return. It has already been paid. It has already been made in past. How will be reclaiming that? By entering in the current VAT return, means for not C, no. By making a separate claim, no, it's not a big amount, and we basically it's an adjustment. It's about adjustment. If you have overpaid a VAT in any quarter, so it can be adjusted in the next VAT return, right? No need to resubmit the incorrect VAT return by submitting a separate VAT return just for overpay. No, it can be adjusted in the current time period. For example, if you have made overpayment for quarter two, this can be made in current, like in quarter three. This can be adjusted. So correct option is option A by entering it on the current VAT return.